It kind of seemed like, we thought this morning with the inflation numbers looking so soft that might be a game changer here for the Fed. And it wasn't, right? Yellen and company are forging ahead. Do you think they're doing the right thing?
Well, good morning. I think it was a very tough day for the FOMC to make this announcement. There were two relatively hawkish aspects of the FOMC announcement. One was not just that they hiked today, but that they basically made no change at all to their anticipated policy path. And the other is that they're preparing now to start unwinding the balance sheet fairly soon. Those were the words that Chair Yellen used in her press conference today. That could be coming quite soon. So this is relatively hawkish on a day when earlier this morning in the United States,
right.
First the Bureau of Labor Statistics released the CPI report, which was very soft.
Yep. And
then the Commerce Department released the retail sales, which was also soft. And it was amazing that the FOMC basically glossed over both of those readings. In fact, there was no reference at all to the retail sales data.
Well, it's interesting, Andrew, because Janet Yellen got so many questions about this whole question of the weak inflation data. It's almost like the economic gods were trying to make the point to the Fed, right? All the things you were counting on to boost the economy on this one day, weak retail sales, weak inflation, weren't there. She was asked at one point if the Fed risked losing credibility. She said no. Does the Fed risk getting a credibility loss?
Well, let's say there are two important aspects of credibility here. The bigger picture is the Federal Reserve committed itself very strongly 5 years ago to a 2% inflation target, as measured by the PCE price index. And ever since then, they've been falling systematically short of that target. And they were continuing to rely on forecasts that are very optimistic. It's also notable today in the latest projections they released that there was no change in their projections for core inflation for next year. Again, basically brushing aside the recent downturn in the core measures of inflation. The other part of credibility is that they signaled very strongly over the last few weeks. They signaled very strongly that they were going to hike at this meeting. And I think they felt like they had to follow through with that. So in some way, it was in conflict with the data dependence, because if they hadn't signaled so strongly over the last few weeks, they would have left open the possibility that some relatively soft data could change their decision today. I think that door was already closed as of a week or two ago.
Andrew, I was going to ask, do they also feel like they need to follow through with this plan, rough as it is, to start letting bonds roll off by the fourth quarter? Because Yellen said, it's going to be as exciting as watching paint dry. But do you think that's also going to be thwarted by, not so impressive data going forward?
Well, let's talk about two important scenarios here. I think the benchmark scenario is the U.S. economy continues to grow moderately, and inflation stabilizes around current levels with some sign that it's heading back upward. In that case, which I think is the one the markets seem to think the most likely, the Fed will do another rate hike maybe in December or maybe next March. And the Fed can initiate the shrinking of the balance sheet maybe in September, maybe sooner. They could conceivably decide in August, or they could decide in September and initiate in October. There's some flexibility there. But that would be the benchmark scenario, and Chair Yellen emphasized that if the economy follows their current expectations, that's what will happen. But the alternative scenario, which I think they should be worried about, I hope they are concerned about, they did say in the statement that they're being very attentive to the inflation developments, is the scenario where inflation doesn't show any signs of picking up, and conceivably the economy looks like it could be faltering. Yeah. The difficulty there is it'd be difficult to go forward with shrinking of the balance sheet or any more rate hikes in a scenario where it's just not clear the direction the economy is heading.
That would be one conundrum, right, Andrew? Staying with the shrinking of the balance sheet, though, how does the Fed perform this task, though, without causing another so-called bond tantrum or taper tantrum, if you will, in the Treasury markets?
Well, I think they've learned some valuable lessons from the snafu a few years ago. If you remember, that taper tantrum started in a congressional hearing where during the Q&A, one of the members of Congress asked the Fed chairman, you know, if it was possible that the tapering might start soon, and he said yes, it's quite possible that could happen. That was the trigger. Markets were not expecting that to be announced in the Q&A of a congressional hearing. So the contrast here is that the Federal Reserve has been very careful over the last few months and even going back a couple of years to lay out the plans very clearly. I think Chair Yellen used the word meticulous today. Yeah. I think that's a fair characterization. So there's no surprises. The markets know exactly how this is going to work, and whether it starts in September, October, or December is a detail now.
Well, Andrew, of course, many people have said, though, this has never been done. It's easy to say it's not going to roil the markets, and Janet Yellen did acknowledge that if it does roil the markets, they could scale back. I want to ask you, though, about data dependence and forward guidance. Does the Fed have to change its paradigm? They don't want to rock the markets. They want to give forward guidance and say, here's where we're going. How can you be data dependent, though? Data weak and you don't move because you can't upset your forward guidance. Isn't this contradictory? Don't they have to change something?
Right. So the communications they gave a couple years ago was to move away from being date dependent and move toward being data dependent, move away from the calendar and toward the economic conditions. But I think that transition has not happened. They're still mostly communicating in terms of calendar dates. So the change that needs to happen, and it might happen next year, especially if some new people join the Federal Reserve Board over the next 6 months or a year, that it's possible they will move toward a more clear quantitative strategy that's conditional, clearly conditional strategy. I think that would be the right direction to go.
Andrew, I want to throw up a quick chart that shows this kind of theme of, again, central bank divergence that we're back to, with the Fed being the only major central bank really to be moving towards tightening. You look at the Bank of Japan, and everyone's saying this week is too early for them to even start thinking about exiting this extraordinary monetary policy because the data simply isn't there. Is there a risk that we're seeing the US economy heading towards this Japan-style trap of a super tight labour market, but, you know, essentially zero wage growth, zero inflation?
Right. There's an important parallel here because what's happened in the United States over the last couple of years is that consumers' inflation expectations have been ratcheting downward by about 0.5 percentage point, which means that in some way the Fed has an uphill battle now to get back to 2% inflation. That's their target, but households and consumers and even some financial market investors, depending on how you read the inflation compensation data, they've been watching 5 years of shortfalls and are losing confidence that the Federal Reserve really has a true commitment to hit its target. It would be better for the FOMC probably to aim high, allow inflation to go a bit above 2, so that if there was, you know, say a cut in cell phone rates, that brings inflation back, say, from 2.2 to 2.0 or 2.1 to 1.9, as opposed to the situation we're in now, which is bringing inflation from 1.5 maybe down to 1.3 by this summer.
Okay, quick final question. If you're a betting man or a forecasting man or a Fed watcher, which you clearly are, is the Fed going to hike in September? Is the Fed going to hike in December? Are they going to hike at all the rest of the year?
Well, again, they should be data dependent. So I think it should be good news for markets if inflation stays on the low side, because it gives the Fed more freedom to follow a shallower rate trajectory. But if the Fed continues to insist that it's going to follow through with the dot plot, you know, which is a date dependent trajectory, that could be bad for the U.S. economy. It could be bad for the inflation. It could be bad for the Fed's credibility. And a year from now, they'll have to figure out how to get out of that.